Welcome to The Explainer. Today we're diving into a question that just about every Canadian entrepreneur faces sooner or later. You know you need that new piece of gear to take your business to the next level, but how on earth do you pay for it? We're going to break down the ultimate showdown, leasing versus buying.
This right here, this is the question we see all the time on forums and in founder groups. It's that classic business problem, right? You got to spend money to make money, but that first big spend can feel impossible when you're just starting out.
So your whole journey really starts with this one core decision. And a simple way to think about it is like this. Leasing is basically like renting an apartment. You pay every month for the right to use the space. Buying, on the other hand, is like getting a mortgage. Every single payment you make is building towards one day owning that house, or in this case, that equipment.
Okay, let's really get into the nitty-gritty. To figure out which path is right for you, we've got to look at the trade-offs. And we're going to do that by looking at 3 areas that are just critical for any growing company.
First up, and this is a huge one, is cash flow. I mean, it's the lifeblood of your business, right? And when it comes to keeping cash in your pocket, leasing is the absolute champ. You usually have a tiny down payment, if any, which means your working capital stays free for other vital things, like payroll or marketing. Buying, well, that requires a big chunk of cash right out of the gate, tying it up in one single asset.
So what happens when the payments finally stop? Well, with the lease, the equipment usually just goes back. And that's that. You don't have anything to show for all those payments. But when you buy, it's a totally different story. Every payment you've made has been building equity, creating a real, tangible asset that beefs up your company's balance sheet.
Now let's think about how fast things change. If you're in an industry like tech, where today's cutting-edge tool is tomorrow's paperweight, leasing is a lifesaver. It lets you easily upgrade to the latest and greatest. If you buy, though, you're the one stuck with that aging piece of machinery, and trust me, trying to sell old equipment can be a real headache.
Okay, now for the really juicy part. Let's talk taxes. Because you better believe the Canada Revenue Agency looks at leasing and buying in 2 completely different ways. And, understanding that difference can seriously affect your bottom line.
So, if you decide to buy, you're going to get very familiar with this term, Capital Cost Allowance, or CCA. Basically, the CRA is not going to let you write off the entire cost of that brand new shiny machine in the first year. No way. Instead, they make you deduct a portion of its value each year as it gets older and wears out.
And this table just lays it out so clearly. See, with a lease, your payments are just a regular operating expense. That means you get to deduct the whole payment every month, which lowers your taxable income right away. When you buy, you deduct that CCA amount plus any interest on your loan. The bottom line? Leasing often gives you a bigger tax break faster, right now. Buying spreads that benefit out over many years.
Okay, so you've done your homework, you've weighed the pros and cons, now for the million-dollar question. Who's actually going to give you the money?
Here in Canada, you've actually got a bunch of different doors you can knock on. You have your usual suspects, the big banks. Then you've got crown corporations like the BDC, the Business Development Bank of Canada. There are also government programs, a whole world of what we call alternative lenders, and sometimes you can even get financing directly from the company that sells the equipment.
But more often than not, it comes down to a classic trade-off, right? Speed versus cost. The big traditional lenders like the banks and BDC, they might give you a slightly lower interest rate, but man, they can be slow and the amount of paperwork can be staggering. The alternative lenders, they might charge a bit more, but they are built for one thing, speed.
And listen to this. This quote from a business owner on Reddit just says it all. They felt like they were getting the runaround from their bank, who just never followed up, but an alternative lender got them an approval on the very same day. It's a perfect reminder that sometimes the cost of waiting around for a slightly better rate just isn't worth it.
But, it's not always so black and white. Some of the big established players are getting more flexible. The BDC, for instance, has some really interesting deals designed for entrepreneurs, like letting you pay only the interest on your loan for up to 2 years. For a new business, that kind of breathing room where you're not paying down the principal right away can be an absolute game changer.
Okay, hang on. Before you sign on any dotted line, we need to talk about a piece of legal fine print that is so important to understand, especially if the equipment you're getting is going to be physically installed or attached to a building.
This is where things can get, messy. Really messy. It's a situation where 2 different areas of the law can crash right into each other, and it can create some serious headaches for business owners and lenders alike. The magic legal word you need to know here is a fixture.
A fixture is basically any piece of equipment. Think of a giant commercial oven in a restaurant, a furnace in a basement, or even those dental chairs that are bolted to the floor, that become so permanently attached to the building that the law starts to see it as part of the building itself.
So let's just walk through a classic example of this. You've got a homeowner who finances a brand new furnace from an HVAC company, but that homeowner also has a mortgage on the house with a big bank. Now let's say things go south and the homeowner defaults on both the mortgage and the furnace payments. A fight breaks out. Who gets first dibs on the furnace? Is it the bank whose mortgage covers the whole property, or is it the HVAC company who actually paid for the furnace?
So what does this all mean for you? Well, here's the crucial takeaway. Your equipment lender is not going to get caught out. They will take very specific legal steps to protect themselves. They'll make sure you sign the security agreement before that equipment is ever installed. And then they'll file a special notice on the property's title. This basically puts a flag on the property saying, hey, everyone, we have first claim on this specific piece of equipment if things go wrong.
So at the end of the day, as you can see, there is no magic answer here. There's no one-size-fits-all solution. The decision to lease or to buy is deeply strategic. It's all about what makes sense for your business, your cash flow, and your big-picture goals.
Ultimately, I think it all boils down to this one question. You have to ask yourself, what is my number one priority right now? Is it keeping as much cash as possible in the bank today to fuel growth? Or is it more important to start building a stronger balance sheet for tomorrow by owning the assets that make your business run? Your answer to that is what will truly point you down the right path.